What's up? Today we'll be taking a look at ETFs KOMP and ARKK. We'll discuss the AI-powered natural language processing algorithm that selects the holdings of the index that KOMP tracks, and we'll discuss the active management of Ark Invest. Additionally, we will examine the portfolio composition of each, the costs, the performance, and also the pros and cons of investing in disruptive innovation in general. Then at the end, I'll give my opinion, because I am the expert in my own opinion. If at any point you decide you like this video, feel free to hit the like button, because that's what it's for. Without further ado, let's get started. KOMP is managed by State Street Advisors. It has been around since 2018 and currently has $2 billion in assets under management. KOMP aims to track the S&P Kenosha New Economies Composite Index, which is an index utilizing artificial intelligence and a quantitative weighting methodology to pursue the potential of a new economy fueled by innovative companies. Companies that aim to disrupt traditional industries by leveraging advancements in exponential processing power, artificial intelligence, robotics, and automation. The index is made up of Kenosha New Economy sub-indexes. Each Kenosha sub-index is weighted by its Sharpe ratio with an annual reconstitution. The Sharpe ratio is a measure of risk-adjusted returns. The greater the Sharpe ratio, the higher the risk-adjusted return. It doesn't matter how good your returns are. If you're taking insane amounts of risk to get them, it's bound to be unsustainable in the long term. The sub-indexes rely on AI to select their holdings. A computer algorithm scans company filings for relevant terms, selects holdings, and classifies them as core or non-core based on the frequency and position of these terms. Holdings within each sub-index are initially equal weighted, with an overweight applied to core firms. Granted, the algorithm does not seem to do any kind of a deep dive into valuation or fundamentals. ARKK is the flagship fund of Ark Invest, managed by rockstar fund manager Cathie Wood. It has been around since 2014 and has $24 billion in assets under management. ARKK is an actively managed collection of the highest conviction names of Ark Invest across the various innovation platforms that Ark Invest focuses on, these being DNA technologies, industrial innovation in energy, automation, and manufacturing, the increased use of shared technology, infrastructure, and services, and technologies that make financial services more efficient. Ark has a specialized team of researchers that believe that disruptive innovation is often priced incorrectly by traditional investment strategies, and thus can present incredible opportunities for those that understand the value and the potential in the emerging disruptive technologies. So while Ark has a specialized research team that actively picks positions, KOMP does it passively with a bot. So do you believe in the algorithm, or do you believe in the active management of Cathie Wood? 90% of active managers fail to consistently beat the market over the long term. They have to do well enough to offset the higher fees that come with active management, but also consider the higher trading costs that come with more buying and selling, and the tax implications of their frequent short-term capital gains. Not saying KOMP is necessarily extremely tax efficient, but we will get into that later. So while the long-term statistics on active management are grim, what Ark does is very interesting because they are laser focused on small pockets of innovation that they hope will revolutionize the world. They are far from the typical active management teams, and they hold high concentrated conviction to some of their favorite names. KOMP, on the other hand, may provide more passive, broad, and diversified exposure to innovation strategies. Speaking of which, let's move into portfolio composition right now. 76% of KOMP's holdings are US-based, 6% are in China. ARKK is 86% US-based. KOMP is well diversified in terms of market cap exposure. 65% of holdings are large cap, 26% are small cap, 20% are mid cap, and 16% are micro cap. There's definitely some volatility that comes with having that many small caps. While small caps are more likely to get hit harder in a market crisis, they have attractive upside in a bull market that can make it worth the risk for many investors. ARKK, on the other hand, is 52% large cap, 27% mid cap, and 18% small cap. Moving into sector exposure, 32% of KOMP is information technology, 21% is industrials, 19% is consumer discretionary, healthcare and communication services are both 9%. Everything else is under 5%. ARKK is similar in information technology at 31%, is much higher in healthcare at 27%, communication services is 21%, consumer discretionary is 13%. Everything else is under 5%. Note that while these ETFs are tech heavy, they are not necessarily all tech, but rather made up of companies that use technology to drive disruptive innovation in their industries. Let's take a look at industry exposure. For KOMP, semiconductors make up 12%. From there, we have a good variety of software, automotive, aerospace, technology hardware, electronic equipment, healthcare equipment, and so on. You might notice that automobiles and auto components add up to 10%, so KOMP can certainly be a bit of an EV play, in addition to some other sustainable energy themes. You'll notice that ARKK is a bit more concentrated in a few industries, particularly biotechnology, software, entertainment, and IT services. Any exposure you get to EVs and clean energy really comes solely through Tesla, as Ark is very much all in on Tesla. KOMP has 406 total holdings. This is notably more than what we see in ARKK, which currently has 54 holdings. In KOMP, no company is over 5%. The top 10 holdings make up 15% of the total weight. It can be incredibly challenging to pick the winners of the new tech, new economy arena. KOMP may be a good way to get broad, diversified exposure to the whole market of disruptive innovation. ARKK may be more of a play for those that believe in the winner-take-most mentality of disruptive innovation. One criticism of new tech ETFs is that new tech tends to just get bought by old tech. However, as we will see, there are plenty of old names in KOMP that continue to reinvent themselves to ride the wave of innovation. Let's run through the top 10 holdings of KOMP. We have Vuzix, 3D Systems, Riot Blockchain, Microvision, GM, Amarella, Tesla, Blink Charging, Avis, and Nano Dimension. Picking out a few more names, we have Nvidia, Lyft, Ford, Alphabet, Plug Power, NIO, Trimble, Microsoft, and so on. I think the type of investors looking into ETFs like KOMP may initially be turned off by older names such as GM, Ford, and Toyota. However, when you look under the hood, pun intended, these companies have recently made notable efforts to build electric vehicles, hence why they get picked up by the algorithm. KOMP seems to have broad focus on sustainable energy as a whole, as opposed to trying to pick specific sectors of clean energy. Moving back to ARKK, 50% of the weight is in the top 10 names. With ARK ETFs, no company can be over 10% of the total weight. So we have Tesla maxed out at 10%, then Teladoc, Roku, Square, Shopify, Zoom, Twilio, Coinbase, Spotify, and Zillow. We can also look at the overlap of KOMP and ARKK. 43% of ARKK's holdings are in KOMP. However, they only overlap 5% by weight. Let's move on to cost. And first with that, net expense ratio, the annual percentage that we have to pay for management. As we would expect, KOMP being passively managed is lower at 0.2%, and ARKK being actively managed is higher at 0.75%. So on a $1,000 investment, KOMP would cost you $2 a year. ARKK will cost you 7.5. 0.2% is pretty cheap, not compared to some of the S&P 500 ETFs that are down around 0.03 and 0.04. But anyone buying an ETF like KOMP is banking on the outperformance of innovation strategies, to the point where that small cost difference is a non-factor. Getting back to ARKK, I will say that 0.75 is not terrible for active management, but if you don't value the active management, then it's just not going to be worth it for you. So let's briefly cover spread costs. Spread is the measure of liquidity and the cost of trading shares, essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically, the larger a fund is and the larger the trading volume, the lower the spread. But both of these ETFs are large and liquid, so it's not much of an issue here. The average spread of KOMP is 0.11% and virtually nothing for ARK at 0.02%. Also, most of us are just buy and hold investors as opposed to traders frequently moving large amounts of shares, so it's not a huge factor for us. We can only cover tracking difference for KOMP as ARKK doesn't track an index and therefore cannot be compared to an index. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. It's a good report card for how well a manager is doing. It can depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The tracking difference of KOMP is actually a positive 0.03%, meaning that it's actually slightly outperformed its index, which is pretty cool. So let's move on to the tax efficiency, or in the case of these two ETFs, probably more the tax inefficiency. Both of these ETFs are growth focused, which tends to be more tax efficient than value focused ETFs that pay more dividends, which are taxed as ordinary income. However, ARK does frequent buying and selling on a daily basis, so a large portion of the gains are short-term capital gains, which are taxed as ordinary income, as opposed to the more favorable long-term capital gains rate that you get by holding for more than a year. Turnover ratio, or turnover rate, is the percentage of a fund's holdings that have been replaced within a given year. So the lower the turnover ratio, the less short-term taxable events. From what I was able to find, KOMP has a turnover ratio of 91%, and ARKK has a turnover ratio of 80%. So this surprised me. I would expect the actively managed ETF to have a much higher turnover than the passively managed ETF, but it seems like the AI of KOMP does a lot of rebalancing. Also, contrast these with something like VOO, which tracks the S&P 500. VOO has an annual turnover ratio of 4%. In any case, it might be better to keep these two ETFs in a tax-advantaged account as opposed to taxable accounts. So let's move on to performance. We don't have much to go on as KOMP is still relatively young. Currently, KOMP is up 80% on the 1 year, and ARKK is up 73% on the 1 year. Looking at the graphs, both of these ETFs are wild rides, but ARKK even more so than KOMP. ARKK seems to rally more in a bull run, but certainly hurts more in a correction. We can see this volatility as we move down to check out other relevant factors. ARKK is more volatile than KOMP, and its holdings are much more expensive. It's safe to say that future growth is priced into both of these ETFs, but more so with ARKK. There's an inherent risk to this, as expectations for these companies are high, Any bump in the road could lead to stagnation and declining prices. The holdings in KOMP also have cleaner balance sheets. Looking at the current snapshot, I think it's safe to say that ARKK is the riskier of the two, but some would say high risk, high reward. As investors, it's important for us to have clear understanding of our individual risk tolerance, and it's important for us to look at potential returns through the lens of how much risk we have to take to get them. Also, let's take a look at analyst ratings. KOMP has an A from FactSet. ARKK has a B from FactSet. ARKK has 5 stars from Morningstar, and KOMP has no ratings from Morningstar. So what are my thoughts? While I'm not a fan of active management, I am a fan of the team at Ark Invest and the innovation spaces they focus on. I'm a firm believer that innovation is the driver of growth, and I want to be invested in companies that will go on to change the world. However, again, investing in disruptive innovation can be inherently risky, as investors can get excited into a frenzy and bid up prices super high only for the company to fail to meet expectations, and then the price can plummet. I am very interested in ways to get low-cost, tax-efficient, passive exposure to innovation themes. KOMP provides a very broad exposure to the innovation space, and ARK aims to pick the winners. However, I'm not sure if I'm sold on an algorithm that selects holdings from keywords in company documents, but I am interested in watching it and learning more. I was also hoping that KOMP would have less turnover. I currently own ARK ETFs, and I do not own KOMP, but I could see myself picking up some KOMP as a way to further diversify and de-risk my exposure to the innovation space. I do want some exposure to some of the high-flying speculative names in disruptive innovation, but I don't exactly want to bet my entire portfolio on it, so I plan on keeping it to a smaller percentage going forward. I also just think owning the NASDAQ 100 and the Next Gen 100 can potentially provide some good risk-return exposure to innovation and growth. This graph is a visual representation of what I mean. If you are interested, check out my videos on QQQM and QQQJ. They are passive and relatively low-cost ETFs. But if you found any of this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your cryptocurrency. As always, this is not to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.